Sometimes you come into earnings season very hot, right? The market's screaming, going crazy, and the expectations are high. Earnings come out, and what do we get? Right, sell the news, right? So that happens a lot. Other times, like this time, we come limping into earnings. Now, by the way, limping is not even the correct give thesaurus here. It's worse than limping, but we come limping into earnings. The bar is set lower, expectations are low, and with even mediocre results, you saw some of these stocks ramp, like Meta, like Tesla, some others. These are not extraordinary earnings. Well, actually, Meta's pretty good. They beat by 70 cents. But for the most part, they weren't extraordinary earnings in general. But here's what investors do, amateurs, and what professionals do around earnings season. First off, no Russian roulette. Do not jump in front of earnings. In fact, if you have a good profit, it's advised to take 80%, 90% off the table, because you'd hate to see a gap down and lose that hard work. So definitely trim into earnings, no doubt about it. Okay, that's number one rule you got to do there. Number two, do not go after the stock that misses earnings, lowers forecast, that's down 30%, and say, oh, it's cheap, it's down 30%. Typically, when an institution wants to dump 400,000 shares, it takes about 3 or 4 trading days to do it. So wait a little bit if you really want to do that. I won't suggest that. Here's what happens in this playbook. So the earnings come out for a company. You did not play Russian roulette. The stock, unfortunately, or the company guided lower. And that's a biggie. That's going to kick them out of a lot of portfolios, especially if they're a growth company. And then what happens? The analyst bandwagon. So it's $100 a share. Analysts had it as a buy rating. Now it's down to 60, hypothetically. We took a big hit. And those same analysts, now we have a sell. So then you get all these analysts and puts pressure on the stocks.